This outcome, where the rate of economic growth declined after a country floated its currency, is consistent across all the countries that I considered. I could not find any country that experienced a rise in the rate of economic growth after it floated its currency. Hi, I'm Lee Harkness. In this video, I'll be considering the effect of the floating exchange rate system on the rate of economic growth. In my previous video, I explained how I found that the floating exchange rate system did not really address the balance of payments. It just changed the people who were responsible for financing the imbalance. That led me to investigate what was the effect of the floating exchange rate system on the economy. I had expected that it would raise the rate of economic growth, but I was surprised to find that my biases were not confirmed. Rather, the floating exchange rate system dramatically slowed the rate of economic growth. This chart shows the gross domestic product per quarter in the United States of America. Before the float, the economy had been growing at around 4%. After the float, the rate of economic growth declined 40% to around 2.4%. It is most likely that the gross domestic product would have been 44% higher in December 1994 if the United States had continued with the fixed exchange rate system and not floated in March 1973. We can see the changes in the growth rate more clearly if we use a logarithmic scale on the vertical axis. For example, as we can see here, the change in the rate of economic growth due to the float is more marked. The 4% growth line is now straight, as is the 2.4% growth line. And we can see again the lost income due to the change in the exchange rate policy. This chart shows the gross domestic product at constant prices in Australia. The line shown is the sum of gross domestic product for 4 quarters. It is for the period of 35 years from December 1960 to March 1996. The Australian dollar had been fixed against the pound sterling until December 1971. Then it was managed against the US dollar until September 1974, when it was managed against the trade weighted index. The US dollar was floated in March 1973 and the Australian dollar in December 1983. The Australian economy had been growing at around 5% per annum before the US dollar was floated. Again, the rate of growth can be seen better if we use a logarithmic scale on the vertical axis. After the US float, the rate of economic growth in Australia declined about 40% also, in this case from 5% to around 3%. Gross domestic product in Australia could have been 52% higher in March 1996 if it had retained the average rate of growth of 5%. That loss of income is more clearly seen if you use a normal scale on the vertical axis. At this point, it may be useful to consider the effect of the floating exchange rate system on Japan. This chart shows the World Bank statistics for Japan for GDP per capita in terms of yen at constant prices. The Japanese yen had been fixed at 360 yen to the US dollar after the war and remained so until August 1971. That was when the US gold window was closed. To better see the effects of the change in the exchange rate system on the rate of growth of GDP per capita, we will again use a logarithmic scale on the vertical axis. Japan floated its exchange rate in 1973, following the US lead. Between 1960 and 1973, gross domestic product per capita was growing at an average rate of 7.6%. As we saw in my previous video, Japan continued to experience current account surpluses after the float because it was an exporter of capital. We know that the high level of investment offshore would have increased the supply of domestic currency on the Japanese foreign exchange market. This would have driven down the value of the yen, making Japanese products cheaper on foreign markets. Therefore, we would expect that it increased Japanese exports. Also, the low value of the yen would have made foreign goods more expensive in Japan. That would have contracted the demand for imports. We could have expected that this would have caused the Japanese economy to grow more rapidly, but we can see that it did not. In 1991, constraints were placed on the growth of bank lending in Japan. That further slowed the rate of economic growth. In those intervening 18 years, gross domestic product per capita grew at less than half the rate it had under fixed exchange rates. That is, it grew at an average rate of only 3.3% per annum. In Japan, there was not the same pressure from the current account balance to restrict the growth of bank credit as in countries experiencing current account deficits. That enabled the banks to increase their lending, and they became prosperous. They became amongst the largest banks in the world. I remember going to a cocktail hosted by Japanese banks in Vancouver in about 1990, and it was the most ostentatious event that I had ever been to, with ice statues and a string quartet. Land prices in Japan rose to exceptionally high levels. It was said in the early 1990s that the palace grounds in Tokyo were worth more than all the land in California. A recession in the early 1990s in the United States of America caused Japanese investors to repatriate their investments in the US back to Japan. That repatriation of funds inflated the value of the yen. It reduced the competitiveness of Japanese exports, which in turn reduced production and the incomes of Japanese manufacturers. Also, it reduced the ability of many borrowers to repay their loans, and that in turn caused the collapse of many Japanese banks. In the subsequent bailout arrangements, the ability of Japanese banks to lend was severely curtailed. As a result, the rate of growth of gross domestic product per capita in Japan has declined to an average of 0.7% since 1991. The stress on people's lives caused by these exchange rate and monetary policy changes is reflected in the crude birth rates shown in this chart. Again, we will show when the yen was floated and when the constraints were placed on bank credit. We can see that when the exchange rate was fixed, the economic and financial stress levels in the community were low, as reflected in the relatively high crude birth rate of 18 per 1,000 people. When the exchange rate was floated, the crude birth rate declined rapidly from 19.4 per 1,000 in 1973 to 9.9 per 1,000 in 1991, and averaged just 13 per 1,000 over the period. That reflects a high level of stress in the community. Formerly, the birth rate was already insufficient to maintain a stable population. Now, after 18 years with the floating exchange rate system, the increased stress in the community had reduced it to about half of what it was. As we saw, the restraint placed on the growth of bank credit slowed the rate of economic growth even further. However, it seems to have also slowed the rise of stress in the community, and while the crude birth rate continued to decline, it did so at a slower pace. We are now going to take a look at the World Bank gross domestic product per capita figures from other countries of interest. To compare the rates of economic growth per capita in local currency terms in these countries, I have indexed them all to equal 100 in 1960. The fastest growing country over this period has been China. The index for China in 2023 is 5,110, which means that gross domestic product per capita in China is more than 50 times higher in 2023 than it was in 1960. The next countries are South Korea, Thailand, and India. To show the next countries more clearly, we will return to using a logarithmic scale on the vertical axis. We then have Japan, Spain, Greece, Austria, Germany, the United States of America, Australia, and For further comparison, Nigeria and Zimbabwe. The three countries that stand out here are China, South Korea, and Thailand. As China has never adopted the floating exchange rate system, we cannot compare its economic performance before and after a float. Its economy grew slowly at first, but has grown more rapidly since the 1980s. Some economists may consider that China has been cheating the system because it has refused to allow the market to set its exchange rate. However, it may be that China has good reason for not floating, and it may not have been subject to the same pressures to float as other countries. South Korea appears to be an interesting case because it was growing much faster than China. Then it suddenly slowed down. The Korean won was pegged to the US dollar until 1980, although it did devalue in 1971, 1974 and 1980. In early 1980, the Korean won was pegged to a basket of currencies consisting of its major trading partners. That new exchange rate system was designed to provide a more stable, real effective exchange rate. In March 1990, South Korea adopted a new system, the market average rate. Under that system, the basic exchange rate of the won was set against the US dollar each day. Initially, it was allowed to trade within a range of 0.4% of the set daily rate. Then, in a series of steps, the range was expanded. By December 1995, it had expanded to 2.25%. Then, in 1997, the Korean won was floated. The rate of growth of gross domestic product per capita between 1960 and 1980, when the won was fixed to the US dollar, averaged 7.1%. It increased to 8.7% when it was tied to a basket of currencies under the real effective exchange rate arrangements. It fell back to 7% when it was linked to the US dollar under the market average rate system. When the Korean won was floated in 1997, the rate of growth of gross domestic product per capita fell to an average of just 3.2%. That is less than half of the rate it had been under the market average rate system, and just over 1/3 of what it had been under the real effective exchange rate arrangements. These changes in the rate of growth of gross domestic product per capita were not due to changes in the world economic environment. If they were, they would have affected other countries in similar ways. To show these examples more clearly, we will revert to using a logarithmic scale on the vertical axis. The average growth rate for GDP per capita in Japan in the comparable periods was 5.7 between 1960 and 1980. It fell to 3.9% between 1980 and 1990 and was 1.4% between 1990 and 1997. It has averaged 0.7% since then. For the United States of America, the comparable growth rates were 2.5%, 2.3%, 1.7% and 1.5%, respectively. It has been the changes to the exchange rate systems that has been the major driver of changes to the economic performance of these countries. I'm not saying that it has been the only driver of changes in economic growth, but it has been an extremely significant factor. Let us look at one more example. Thailand had a fixed or managed exchange rate system until July 1997, when the Thai baht was floated. It was fixed against the US dollar until 1984, when that was changed so that it was fixed against a basket of currencies. GDP per capita was growing at 5% per annum on average before the float, that is, between 1960 and 1997. Actually, during the period it was tied to the US dollar, GDP per capita grew at 4.4% per annum. Then, between 1984 and 1997, when the baht was tied to a basket of currencies, it grew at 5.9% per annum. It is worth noting that, like South Korea, the Thai economy grew faster when it was tied to a basket of currencies than it did when it was tied to the US dollar. Since 1997, when the Thai baht was floated, GDP per capita has grown on average at 2.2% per annum. That is half the rate it was when the baht was tied to the US dollar, and less than 40% of the rate it had been while the baht was tied to a basket of currencies. This outcome, where the rate of economic growth declined after a country floated its currency, is consistent across all the countries that I considered. I could not find any country that experienced a rise in the rate of economic growth after it floated its currency. If you know of any, please advise me in the comments. In my next video, I will be considering why the rate of economic growth declined when countries floated their currencies.